Chapter 12, how to avoid bad trades. Now, this chapter may be shorter than the chapter on entry signals. However, that does not make it any less important. If anything, how to avoid bad trades is more important than knowing how to enter good trades. So we're going to touch on a few key parameters that I use when I'm trading, especially in the VTF with our other traders, to help me avoid bad trades, because it's very important for me to be able to show you how to identify trades to not be involved in. Remember, there's three types of trades. You can go long, you can go short, or you cannot trade at all. So let's get into how to avoid those trades that you should not be trading at all. In this chapter, I'm going to touch on how to identify reset or accumulation, which at this point you should understand has a lot to do with the TDI, liquid 50, stationary 50 positioning, RSI value, and things like that. We're going to touch on using news and how to avoid bad trades because of news events. And I'm really going to highlight in a couple chart examples how the liquid 50 positioning, how close it is to the stationary 50, and which direction it's moving really plays a part into avoiding bad trades. Reset is defined when the EMAs do not agree on trend with the TDI, or when the EMAs are coming together. So if all the EMAs are bunched up tight together, like they're laying on top of each other, as I'm going to show you in the next few slides, then you're going to see that that is how we identify reset. That leads us to identifying it as a choppy market, a market that we would not want to be involved in. When the TDI is saying to trade in one direction, for example, sell, but the EMAs are saying to go long, they're in a disagreement, which we know is now divergence. The divergence tells us that this pair is in reset, and it's probably safer, if you're going to trade it, always to trust the TDI, but it's probably safer to just not trade at all. Avoid trading in reset. That's the number one thing that you need to take out of this chapter. You're going to be able to define reset even more specifically when you look at the TDI. The liquid 50 and RSI value will be near the stationary 50 value if you're in reset. The RSI might also coil, get really tight together, making higher lows and lower highs closer and closer together. Or you might see the entire TDI, liquid 50 trend line, and RSI all consolidating at the stationary 50. So any of these are indicators to us that we might be in reset. So when you lay these reset parameters for the TDI on top of the reset parameters for the EMAs, and you have EMAs going in one direction and maybe the TDI doesn't agree, or maybe the liquid 50 is too close to the stationary 50, then you have reset, and it's better to stay out. The worst that happens, I've said this the whole course, the worst that happens is you miss a winning trade, you come back tomorrow with money in your pocket, and you try to find another one. That's the worst thing that happens. You'll live like that, I promise. So let's go into an example of reset here. You can see at the start of the day, the liquid 50 starts in the sell zone, but during Asia and into the beginning of London, moves up towards the stationary 50 value. That tells us that this is coming into reset. It's confirmed reset when you look at the EMAs. Now you can't see the 800 EMA in this photo, it's below it, but if you look at just the shorter term EMAs, the 50 and the 200, the water and the Mayo, look how all through Asia and all through London, they're coiled together, completely on top of each other pretty much. Indecision in the direction, then it breaks out long and decides the next day it's going to continue in that direction. It's no coincidence. This is the coiling, this is the reset, the accumulation zone. You get the break of the zone, the retest of the zone overnight, it breaks out again in the direction of the trend. Look how the liquid 50 moved into the buy zone. So we want to avoid trading it here and try to trade it maybe the next day if it fits the parameters. But avoid trading when the liquid 50 gets this close to the stationary 50. It's very important. Please listen to me. Avoid trading when the liquid 50 gets this close to the stationary 50. Just let it go. Another example here, we have the liquid 50 at the start of the day dropping towards the stationary 50 from the top of the buy zone, middle of the buy zone, 60, 65 value, towards that 50 value, telling us we're coming into reset, and that's confirmed when the EMAs are saying the same thing. We have the shorter term EMAs, the 50, the 200, all telling us we're going to buy, but the long term EMA, the blueberry, the 800, is on top, telling us that we're still in an overall downtrending market. So in this disagreement, plus with the liquid 50 so close to the stationary 50, you would just not trade it. You would wait till it breaks out and trade it in the direction it breaks out whenever it presents the next S2. So in example 3, you can see here we have the liquid 50 start the day in the sell zone, but move into the buy zone through Asia and through London. However, we know this is reset because it's, number one, the liquid 50 switched zones. We like to see the liquid 50 in either just the buy zone or just the sell zone to be in a really strong trend. But this example in particular is confirmed because the EMAs are saying sell, but the TDI moved into the buy zone, which would tell us to buy it. So we would not want to trade something that's in disagreement like that. Just avoid trading completely. In this example again, you can see why this would be a bad trade. We have the EMAs crossing overnight, so telling us that we're moving into an uptrend. Liquid 50 is in the buy zone, but when you look closely, from about 3 a.m. till 9 a.m., when we would be looking to trade, the liquid 50 is actually dropping. RSI is dropping towards the stationary 50. That tells us it's coming into reset, and you want to avoid trading it until it shakes out. And notice how the next day it continues the uptrend. It doesn't change direction. It's in a much better position for us to trade it because the liquid 50 has separated itself out of reset. And that's much better for catching clean trending trades. You're not going to catch clean trending trades when you're trading a dropping liquid 50 out of the buy zone. You want to be trending a flat or uptrending liquid 50 in the buy zone. We said that when we defined the TDI. Just like when you're selling it, you want to be trading a flat or dropping liquid 50 in the sell zone. So now I'm going to show you a few examples again of just bad trades. So here we have the liquid 50 in the buy zone all day on the 15-minute. However, during the end of Asia and throughout London, the liquid 50 is dropping left to right. You see it's dropping. We do get a 2-candle railroad formation that I have boxed in here on the 15-minute. However, because that liquid 50 is dropping, you can see it throws 2 pins high and then turns right around and would easily stop you out. So this is an example of being able to avoid a bad trade, a trap move. This is a trap move because you're not wrong on the direction. You were right that he's got to go long today, but you were just early. And you were early because you were trading the liquid 50 when it wasn't ready to turn up and make that move. Once the RSI set the reaction point here and then came back through into the buy zone, we knew that this had been set as the level and the liquid 50 should hold into the buy zone throughout the day, and you could, again, take it long later in the day. But for this entry here, where you would see this railroad forming and you might get excited, be careful with this dropping liquid 50. You want to avoid going long until you are proven that you are in an uptrend, like it does here later in the day. Another bad trade I want to explain to you here, we have a liquid 50, starts in the sell zone, kind of breaks into the buy zone, but then stays right near the stationary 50 value in the sell zone. This is a trade where we would be looking to go short because we are in the sell zone just near the stationary 50, but definitely the sell zone, so you're looking to go short. EMA say sell. However, this trade here, when we would be looking to go short right around, what is that, 9, 10 in the morning? Yeah, just about 9, 10 in the morning. This trade happens before we have broken out of the initial high and initial low set in the Asian range. You see how I have that boxed off with the orange box? You want to wait until you break out of the box and then catch your trade, not trade right out of the accumulation range. If you trade right out of the accumulation range, you don't get the full move sometimes. It's not done accumulating like it is here. It pushes out of the box, induces you to get short, and then returns right back in and stops you out. The reason for that, and you can identify that by not trading within the initial high and initial low and seeing that the TDI is telling you we're in reset. The liquid 50 is not trending. You would want to see it much lower, much more down near 40, 44, or if you're buying it near 56, 60, something like that. Again, another reset trade example here. We see the liquid 50 dropping overnight, even though it's in the buy zone, dropping into reset. EMAs are coming together, and there's a trap move in here with this railroad formation. There's a 1-minute cross right here at 450 off this railroad. But why we would not want to take it, why would we not want to be involved, is because of this dropping liquid 50. If this was inverted and it was a rising liquid 50, absolutely take it. But you're not going to see that because the EMA, the 800 EMA, is above you. You're still in an overall downtrend. This was coming into reset. There's money to be made both ways in reset. Like I said, it's a choppy market, but you don't want to get involved. Just stay out, wait for the trend, go to the gym, enjoy your day, come back the next day and find the S2 trade. Maybe on that pair, maybe on another pair. Don't be biased, but if it's in reset, just be okay with letting it go for the day. Don't be married to it. Don't tie yourself to it. One more bad trade example here. We can see this has a really nice example of what we look for to identify divergence. So we see the liquid 50 start in the buy zone, drop into the sell zone, which would tell us that maybe we're looking to go short. EMAs are saying sell as well. However, with my brown line on the RSI, you can see we were able to identify divergence, which created an uptrend for the RSI. You see how the RSI then moved into an uptrend following the pink line? Look how the candles respected the pink line as well. So because of this divergence, we were able to avoid another trap trade and then identify this uptrend that would say, hey, even though the TDI says sell, even though the EMA say sell, stay out of this trade. You are in a short-term uptrend. Wait for the next breakout. Now you guys should understand exactly what reset looks like. It's when that liquid 50 is coming towards the stationary 50. It's when the liquid 50 and EMAs disagree, and it's when the liquid 50 is not in one zone throughout the entire day. We really want to find trending trades in order to be the most profitable that we can be. So in order to do that, you need to be able to identify reset and stay out of those trades. In the next chapter, we're going to walk through start to finish. Now that you've seen the good, the bad, and the ugly, we're going to walk through the entire S2 Trader checklist one more time. That way you really understand exactly what you should be doing every single morning when you wake up to identify potential trade setups, and now after this chapter, trades that you should not be involved in as well.